lot of the people who are chasing that sort of thing very hard now in the venture capital field are losing a lot of money. It's a wonderful field, but not everybody's going to win big in it. A few are going to win big in it.
Would shareholders have been better off if you had continued to invest in capital-light companies?
Well, we'd love to find them. I mean, there's no question that buying a high return on assets, very light capital intensive business that's going to grow beats the hell out of buying something that requires a lot of capital to grow. And this varies from day to day, but I believe, and I don't think it's sufficiently appreciated, I believe that probably the 5 largest American companies by market cap, and some days we're in that group and some days we aren't. Let's assume we're not in that group on a given day. They have a market value of over $2.5 trillion. And that $2.5 trillion is a big number. I don't know whether the aggregate market cap of the U.S. market is, but that's probably getting up close to 10% of the whole market cap of the United States. And if you take those 5 companies, essentially you could run them with no equity capital at all. None. That is a very different world than when Andrew Carnegie was building a steel mill and then using the earnings to build another steel mill and getting very rich in the process, or Rockefeller was building refineries and buying tank cars and everything. Generally speaking, for a very long time in our capitalism, growing and earning large amounts of money required considerable reinvestment of capital and large amounts of equity capital. The railroads being a good example. That world has really changed, and I don't think people quite appreciate the difference. You literally don't need any money to run the 5 companies that are worth collectively more than $2.5 trillion and who have outpaced any number of those names that were familiar if you looked at the Fortune 500 list 30 or 40 years ago, whether it was Exxon or General Motors or you name it. So we would love, there's no question that a business that doesn't take any capital and grows and has, almost infinite returns on required equity capital is the ideal business. And we own a couple of businesses, a few businesses that earn extraordinary returns on capital, but they don't grow. We still love them, but if they were in fields that would grow, believe me, we would, they would be number 1 on our list. We aren't seeing those that we can buy and that we understand well. But you are absolutely right that's a far, far, far better way of laying out money than what we're able to do when buying capital-intensive businesses. Charlie?
Yeah, the chemical companies of America at one time were wonderful investments. Dow and DuPont sold at 20 sometimes earnings, and they kept building more and more complicated plants and hiring more PhD chemists, and it looked like they owned the world. Now most chemical products are sort of commoditized, and it's a tough business being a big chemical producer. And in comes all these other people like Apple and Google, and they're just on top of the world. I think the questioner's basically right that the world has changed a lot, and that the people who have made the right decisions in getting into these new businesses that are so different from the old ones have done very well.
Yeah, Andrew Mellon would be absolutely baffled by looking at the high cap companies now. The idea that you could create hundreds of billions of value essentially without assets. Without tangible assets. Fast, yeah. But that is the world. There's when Google can sell you something that where Geico was paying $11 or something every time somebody clicks something, that is a lot different than spending years finding the right site and developing, iron mines to supply supply the steel plants and railroads to haul the iron to where the steel is produced and distribution points and all that sort of thing. Our world was built, and when we first looked at it, our capitalist system basically was built on tangible assets and reinvestment and all that sort of thing, and a lot of innovation and invention to go with it. But this is so much better, if you happen to be good at it, to essentially be able to build hundreds of billions of market value without really needing any capital. That is a different world than existed in the past, and I think it's a world that's likely to continue. I mean, the trend is. I don't think the trend in that direction is over by a long shot.
A lot of the people who are chasing that sort of thing very hard now in the venture capital field are losing a lot of money. It's a wonderful field, but not everybody's going to win big in it. A few are going to win big in it.
Amazon has been hugely disruptive due to the brilliance of Jeff Bezos, whom Charlie earlier called the business mind of our generation. What is your current outlook on Amazon, and why hasn't Berkshire bought in?
Well, because I was too dumb to realize what was going to happen. Even though I admired Jeff, I've admired him for a long, long time and watched what he was doing, but I did not think that he could succeed on the scale he has, and I certainly didn't even think about the possibility of doing anything with Amazon Web Services or the cloud. So if you'd asked me the chances that while he was building up the retail operation, that he would also be doing something that was disrupting the tech industry, that would have been a very, very long shot for me. And I've really underestimated the brilliance of the execution. I mean, it's one thing to dream about doing this stuff online, but it takes a lot of ability. And you can read his 1997 annual report, and he laid out a roadmap, and he's done it in spades. And if you haven't seen his interview on Charlie Rose 3 or 4 months ago, charlierose.com, go to and listen to it, because you'll learn a lot. At least I did. So I just plain, it always looked expensive, and I really never thought that he would be where he is today. I thought he was really brilliant, but I did not think he would be where he is today when I looked at it 3, 5, 8, 12 years ago, whenever it may have been. Charlie, how did you miss it?
It was easy. What was done there was very difficult, and it was not at all obvious that it was all going to work as well as it did. I don't feel any regret about missing out on the achievements of Amazon, but other things were easier, and I think we screwed up a little.
No. We won't pursue that line.
Well, I meant Google.
Well, we missed a lot of things.
Yes.
We missed a lot of things.
And we'll keep doing it.
Yeah. And we'll have a
Luckily, we don't miss everything, Warren. That's our secret. We don't miss them all.
Okay, we better move on, I think. He may start getting specific. Carol.
The creator of this question, Jim Kiefer of Atlanta, has even higher expectations for Warren's longevity than Charlie does. Mr. Buffett, we all hope you win the record as mankind's oldest living person. But at some point, you and our Charlie will go, and Berkshire stock may then come under selling pressure. My question is, if Berkshire stock falls to a price where share repurchase is attractive, can we count on the board and top management to repurchase shares? I ask this question both because of past comments you have made about not wanting to take advantage of shareholders and because some of the passages in the owner's manual lead me to believe this might be an instance when the board does not choose to repurchase shares. Can you clarify what course of action we might expect about repurchases in the circumstances I have outlined?
Yeah, well, as far as I'm concerned, they're not taking advantage of shareholders if they buy the stock when it's undervalued. That's the only way they should buy it, and they should. But in doing so, there were a few cases back when Charlie and I were much younger, where there were very aggressive repurchases or the equivalent of repurchases by people, and the repurchases incidentally made a lot more sense then than they do now, but they were done by people who either, for various techniques, tried to depress the shares. And if you're trying to encourage your partners to sell out at a depressed price by various techniques, including misinformation, but there's other techniques, I think that's reprehensible. But our board wouldn't be doing that. I'll take exception to the first part of it, but I'll still answer the second. I think the stock is more likely to go up. If I died tonight, I think the stock would go up tomorrow, and there'd be speculation about breakups and all that sort of thing. So it would be a good Wall Street story that this guy that's obstructed breaking up something where some of the parts might sell for more than the whole. They wouldn't necessarily probably be worth less than the whole, but might sell for temporarily for more than the whole, and it would happen. So I would bet in that direction. But if for some reason it went down to a level that's attractive, I don't think the board is doing anything in the least that's reprehensible by buying in the stock at that point. No false information, no nothing. And their buying means that the seller would get a somewhat better price, or if there are a lot of sellers, they'd get a mildly better price than if they weren't buying, and the continuing stockholders would benefit. So I think it's obvious what they would do, and I would think it's obvious that it's pro-shareholder to do it, and I think they would engage in pro-shareholder acts as far as the eye can see. I mean, we've got that sort of board. Charlie?
Well, I think you or I might suddenly get very stupid very quickly, but I don't think our board is going to have that problem.
Well, I want to think about that one.
Earlier today, Mr. Munger commented on the valuation of China versus the U.S. market. My question for you is, are market cap to GDP and cyclically adjusted PE still valid ways to consider market valuation, and how do those influence Berkshire's investment decisions? Thank you.
Charlie, I think, I guess Charlie's overall value in China. I would say that both of the standards you mentioned are not paramount at all in our valuation of securities. It's harder. People are always looking for a formula. And there is an ultimate formula, but the trouble is you don't know what to stick in for the variables in it. But that's the value of anything being the present value of all the cash it's ever going to distribute. But the PE ratios, I mean, every number has some degree of means more sometimes than others. Evaluation of a business is it's not reducible to any formula where you can actually put in the variables perfectly. And both of the things that you mentioned get bandied around a lot. It's not that they're unimportant, but sometimes they can be very important. Sometimes they can be almost totally unimportant. It's just not quite as simple as having one or two formulas and then saying the market is undervalued or overvalued, or a company is undervalued or overvalued. The most important thing is future interest rates, and people frequently plug in the current interest rate, saying that's the best they can do. After all, it does reflect a market's judgment. And the 30-year bonds should tell you what people who are willing to put out money for 30 years and have no risk of dollar gain or dollar loss at the end of the 30-year period. What better figure can you come up with? I'm not sure I can come up with a better figure, but that doesn't mean I want to use the current figure either. So I would say that I think Charlie's answer will be that he does not come up with China versus the U.S. market based on what you've mentioned as yardsticks. But no, Charlie, you tell him.
All I meant was that I said before that the first rule of fishing is to fish where the fish are. Is that a good fisherman can find more fish in China if fish is the stock market. That's all I meant.
Yeah. I'm going to go back.
It's a happier hunting ground.
This doesn't really directly relate. I want to go back to one question that was mentioned earlier. I really think if you want to be a good evaluator of businesses, an investor, you really ought to figure out a way without too much personal damage to run a lousy business for a while. I think you learn a whole lot more about business by actually struggling with a terrible business for a couple of years than you learn by getting into a very good one where the business itself is so good that you can't mess it up. I don't know whether Charlie has a view on that or not, but it was a big part of our learning experience, and I think a bigger part in the sense than being involved with good businesses was actually being involved in some bad businesses and just seeing
how awful it was,
how awful it is, and how little you can do about it, and how IQ does not solve the problem, and a whole bunch of things. It's a useful experience, but I wouldn't advise too much of it. Well, you think so, Charlie? Here, yeah.
It was very useful to us. There's nothing like personal, painful experience if you want to learn. And we certainly had our share of it.